Good evening, friends, and welcome to the first episode of our new series, the Smart Investing series. As the name suggests itself, this is a series which is directed at the investors and it is meant to help them make the right investment decisions. Okay. And what could be more important than choosing which mutual fund to select? And to do that, we have with us two experts, uh, Dhirendra Kumar and K.S. Rao. Dhirendra, as all of you know, is the CEO and founder of Value Research. This is India's leading and independent website tracking, mutual fund tracking website and magazine. Uh, Dhirendra has been running this since 1990, and this is the only thing that he's done. In fact, if you were to ask people to put a face to the mutual fund industry, uh, I'm sure for many people in this audience, the first uh, face which would appear in their imagination would be Dhirendra Kumar. To many people, he is Mr. Mutual Funds. Okay. Now, I'm happy to introduce another gentleman, distinguished gentleman. His name is Mr. K.S. Rao. He is the Senior Vice President and he looks at investor education and distribution development at Aditya Birla Sun Life Mutual Fund. He has altogether 34 years of experience with him. He has been instrumental in winning many awards for his fund house in the area of investor education, including the much coveted Asia Asset Management Award. Okay. Now, his mission also is to make every Indian financially literate. So we have two stalwarts, and to that end, he has conducted 9,900 programs, and he expects to reach the important milestone of 10,000 by 25th of July. So, welcome to both of you, and over
Thank
to
you.
you, Mr. Rao.
Thank you so much, Prem. Indeed, it's an honor to be part of this session, part of this series of smart investing in association with Cafemutual. And when you put it rightly, this session is going to be with a mutual fund man, Dhirendra Kumar. And I had a privilege in my life to work with the milkman, that is Dr. Varghese Kurian. And second is a privilege to partner with Dhirenji over a period of time on many of these things. And anything you need to know about the mutual funds, the right person to knock is the value research and at Dhirendra Kumar. Ask anything, you get there. And what a series to start the smart investing with and choosing the right mutual fund with Dhiren. Good evening, friends. Welcome you all. Thanks so much for being here with us this evening. And sometimes we may be thinking most of us would have invested in the mutual funds and most of us would have done our financial planning, but some of us may be always confused. What is which scheme to invest and what to invest and how to go forward, uh, and what is the way to look at. And today mutual funds have become a preferred choice, and we look at the kind of SIP book in the industry, and 10 crore folios is a landmark at this point of time. And we are talking about which mutual fund scheme to choose and what is the right fund. And if you ask me, I mean, every mutual fund scheme is the right, but is it right for you? This is a conversation which we are going to have. And we all need to remember it's not the single scheme or single fund, but what you choose and how you choose. Predominantly when I go to my financial advisor, they keep talking to me on my identifying my goals and my objectives. And scheme also got an objective. Whether you are matching the scheme objective with your investment objective. Apart from that, various other parameters which we look at, it could be a fees, it could be a load, it could be open-ended, it could be a close-ended, it could be a equity, debt, or or asset allocation funds, and we have series of schemes. With this, we will have Dhiren will be taking us, with his practical experience and his deep understanding on the subject. And he comes, he is also an encyclopedia on the mutual funds, and especially in Indian context, entire history, how the mutual fund industry is evolved. And that's where value research was there. Now it's value research, little over almost 3 decades of service of value research. Dhiren, the first question to start with, there are thousand odd mutual funds, open-ended mutual fund schemes in the industry, and there are various asset classes, and we talk about asset allocations, we talk about equity and debt, and within the equity we have large cap, multi cap, mid cap, and small cap. Sometimes it confuses the investor. And how can an investor choose the right fund to them? And what are the factors choosing the mutual funds in each of the category? I mean, over to you with your own practical wisdom. We look forward to listening to you.
No, mutual funds were supposed to simplify an investor's life. And simply, by sheer, because they have existed for this long, at a certain level, they are also a consumer product. A lot of funds are getting created simply because, it could be of appeal to consumers. Plenty of different kind of mutual funds have come into being. In fact, the regulators themselves have classified funds. They had to actually work towards classifying them. So we have nearly a dozen types. And I'm talking of the regulatory classification is a very broad one. They say large cap, mid cap, small cap, and this and that, and value, and whatever. But that too about a dozen kind. But within that, there is a possibility of having another. Say, for example, the index fund, and you can have a dozen kind of index fund, because every index is is a different fund. Then different kind of sector funds is possible. Then there different kind of geography is possible. Then the different kind of theme is possible. So at a certain level, investors are left confused where to invest. Likewise, fixed income, in fact, that is even more complex. People think that, okay, I don't have to take chances with my money, and I want to optimize my return on fixed income, and I don't want to do my deposit, because you just want little bit of tax efficiency and little superior return, reasonable liquidity. And when you go about looking for one, you have 16 kind of official 16 official kind. And but there are steps in that direction, but that may be the complexity of choosing. But most investors can actually steer clear of all this complexity. Most investors, they can choose their few funds. For example, if there's a first time investor who is coming, I would ask him to start with a balanced fund. Start with a hybrid aggressive hybrid fund, because it is a steadier take on equity, and keep doing that, keep investing in that for 3 years. Or if you will be able to save taxes, put your money in a tax saving fund. Tax saving fund is just another equity fund with 3-year lock-in. So you can forget about all other categories, because there is a life cycle of every investor. Investor should start in a manner that he's able to build confidence about the way he's investing. So there could be many kind of fund. Once you are settled with the funds, you have invested in a market linked product, and then you get used to the ups and downs, and then you are ready for investing in an all equity fund. Likewise, fixed income fund, one can do without this 16 kind. And in fact, there is a step in that direction, that things are getting even more clearer, particularly after a crisis that happened in the fixed income industry. That SEBI has specified, every fund will have a 3x3 grid, which will be a matrix where every fund will be marking that where it stands. And the 3x3 matrix is on the dimension of credit risk, which is the likelihood of getting your money back, and likelihood of getting the interest repayment. And the other dimension is what is the term of the bonds that the fund will hold. But one important axis which is missing here is the liquidity, because in the worst of times, every time we have seen that the mutual fund, fixed income funds face a crisis, it is primarily because there's a liquidity crisis. Something happened, and a lot of people turn up to redeem their investments, and they're unable to pull out, take that investment. And that is what we have seen the recent crisis was, and that is how it has been in the past. So, but I think investors can do without this complex category available: liquid fund, short-term fund, and look no further. Most of your needs will be fulfilled. And if you're looking at maximize or optimizing your return as compared to fixed income with little bit of risk, little bit of market linking, at best consider those conservative hybrid funds. These funds have 10-20% into equity, remaining in fixed income, and they have the potential to at least match the inflation with the return, because many a times fixed income returns may not be able to match that.
Thank you so much, Dhiren, for the detailed answer. It's I mean, I'm sure investors would have got, the audience would have got this journey. In though mutual fund industry looks with 1,000 products, little complex, but as an investor, when I am choosing, it is all that where I want to go, what is my destiny, and what are the products, how I can simplify. I don't need to keep very complicated. I mean, if you are a first-time investor, as Dhiren rightly said, start with a hybrid fund, and if you are a tax saving, CLSS is the best way to look at, and then you can look at how your fixed income you can simplify the whole norm. It's a later part. We'll have a conversation with Dhiren. How many funds you need to hold, and what is that ideal and optimum number of funds. But Dhiren, the next question comes is most of the times investors, like when I meet investors, they come to your website and they go by the ratings, and they go by the top performing funds. I remember when I travel with you many of the places, sometime when you are mentioning to, especially on the fixed income, don't go by the top performing fund.
Yeah.
It's a criteria you kept, and they go by the this performance is always the past performance, and past performance does not guarantee the future returns. Same is the case vis-a-vis past failure does not guarantee the future failure. However, while you are selecting the decision, it's depending on the past performance, my investment for the future, but decision is taken in the present. To what are these aspects I need to consider as an investor to invest, selecting which is the right mutual fund scheme for me, and how I can simplify things, and what are three simple things which can help the investor to choose the right fund.
No, one is that, ratings could be useful, but, I'll tell you how I use ratings, or, how people, analysts at Value Research use ratings. We use it as an elimination criteria. The funds which are 1 star and 2 star, and that too with 5-7 year history, they have not been able to generate superior risk adjusted or below average risk adjusted return. So it actually reduces my universe of selection. First and foremost, when I'm looking at, I have to choose the category properly. If I'm looking for an equity fund, then I have to choose a category which is diverse enough. You have very few categories there: the flexi cap, the multi cap, and maybe the large and mid cap category. So that will fulfill your need. Doing that, dropping the ones which are 1 star and 2 star, which is, and then you have a limited universe to choose from. From those funds, particularly in case of equity, we look at the performance in a full market cycle, and performance in the and if we have two market cycle, the better. And typically, and it could be a time frame which cannot be defined in a frozen. We can't freeze that time. It is not 3 year, 5 year. We have to see a prolonged declining phase or a rising phase, and two phase will actually make it worthwhile. And also, has the fund manager been around? If you are looking at any such thing, and the fund manager has the change, then you really can't attach the performance to him. A bit of it, yes, you can, to the process and the fund company. And I have found that most great funds, they turn out to be delivering little superior return than in a rising market, and they fall less in a falling market. And that does the magic for the holding for a long period that you hold the fund. In fact, choosing the fund based on recent past performance is like looking at the rear view, and that could be very dangerous. Definitely, the rear view. When you look at an extraordinary return, it is generally that the fund has assumed some extraordinary risk, and the fund has not been penalized for that risk, and that is why it looks exceptional. And that is the warning sign. So there is a possibility that if you are investing in a fund which looks extraordinary, and the risk has not visited that fund or has not hit the fund, and there is a possibility that once you buy it, once you invest in it, you will be hit by that. So, and there is a reversion to mean. So it could be risk, it could be reversion to mean. So one is that people chase performance, recent performance. But it's not only a bad idea, it's a risky idea, it's a dangerous idea, it will hurt you.
Okay. Thank you, Dhiren. But there is a follow-up question I would like to ask here. I mean, there are a lot of data available. I mean, you put it very rightly. This data is to sometimes before selection, it's an elimination. Recently, I was recruiting a few of my team members, and I find those interview panel, I find many of them are very good. I mean, if I have given a choice, I can take everyone, but I need to take very few and I need to eliminate. Then I need to use about their how they have come till here and how they are. I mean, I could assess what is the potential they can deliver in the days to come and which can match for me. For an investor, I mean, when he has to choose for the future, what is that like? There is a fund manager performance, there is a asset management track record, or the AUM under the scheme, and many criteria. Is there is anything we can simplify? This is what I can look at. Of course, after 1 year, if I review, then I can get back whether I'm right or wrong. But is there is anything we can see to select the fund?
I wish it was simple. We could actually have one or two criteria, and none of it is actually a guarantee. You can look at any of these variables, and the future is uncertain. In fact, one should not forget that the statutory disclaimer that is being read hurriedly in a mutual fund ad is real, and that past performance may not be repeated. So that is one. The other is that there are just too many moving parts. If there's an excellent fund, if there's an outstanding fund, and there is a brilliant fund manager, but the economy and the corporate environment is very hostile, he can't do anything. Despite choosing great companies, there could be and even if he's lucky by choosing good companies, but there could be a prolonged phase, where some of these companies or they just don't perform. So there are just too many. One is assuming the market risk, and that is something which one has to take it as given. Then comes, are there risks? You have to see that how is the risk managed. We can check all those variables. That hygiene one can check, but the brilliance cannot be validated, and the brilliance cannot be banked upon. Because at any point, if there is a great performance, you don't know whether it is luck or brilliance. And in a rising market, we know that everybody everybody looks brilliant, but a lot of it could be luck. So my sense is that we only we work on a best effort basis. We try and eliminate all those possibilities which have the likelihood of going wrong based on unhygienic practices, and that's about it. It's on the assumption that if these variables are in place, and I'll tell you what are those variables. The fund should not get skewed in one direction, whether it be sector, whether it be companies. Or otherwise you will have to do that thing at your level. You will have to combine a large cap, mid cap, and small cap in your own way, and then you will be left with a lot of decisions to make. That how often do you rebalance? Should you actually choose a index fund rather than actively managed large cap fund? So these are the kind of things. So if you want to keep a low maintenance, simple approach to your portfolio, your investment choice, then you have to look at these things. Is it diversified enough? Has it done well? And it should not be a 1-star or 2-star fund. And if it has done well, then I think give that fund a time. There is another thing which actually hurts investors many a times. That I'm saying that look at a fund on a full market cycle. But most investors want their funds to do well over a long period of time. At the same time, they want their funds to do well on a quarterly basis as well. That's not possible. I think the finest of fund, they will have a phase. Don't give up on that. In fact, for investors, they get a reward for sticking to a fund for a period. And the very reason why a fund succeeds often is the same reason why the fund is disappointing on occasion. And you have to stick to it. We have seen it with many fund managers. We have seen it with many funds. And there will be a period of lagging performance, and you have to stick to it, understand it. That is why I was saying that your discipline, your framework is more important, and belief in the fund manager. And if you're paying for the active management, rather bank on it.
Thank you so much, Dhiren. You always comes with your wisdom. Audience, my request with each one of you is use the Q&A box for your questions, and either intermittently we take some of your questions, or at the end of the session we will have all your questions being answered by Dhiren. I mean, it's use the Q&A box for the questions. Dhiren, coming back to you, I mean, taking the Q further, there are 3 asset categories broadly we look at in the mutual funds. It's the equity, debt, I mean, probably hybrid if it's not an asset class as a fund. Will the principle of the fund selection, if somebody has to select, is it the same, or for each of the category, do we need to have something different?
No, equity and debt are completely different animals. And hybrid funds, we at Value Research look at it very differently. Over a period of time, we have validated, we have developed a framework of analyzing hybrid fund, and it's hybrid funds are evaluated primarily for their discipline, for their ability to, for their the way they rebalance, how often they do it, and how the equity and fixed income is managed, because the fund manager has absolute discretion in terms of the way they manage it. No hybrid fund actually tells you that the equity will be a large cap or a multi cap or some such thing, and even the fixed income part, they don't tell you that this will be run as a dynamic fund, or it will be a short term fund, or it will be a long term fund, or it will be a gilt fund. So because they have absolute, they are at absolute liberty to manage it the way they want, we evaluate them primarily for the discipline, how often they rebalance, and how well they have done with their equity and fixed income choices. Equity, as I said, that we look at it comprehensively. Debt, we look at it very differently. Our way of looking at debt, we are far more stringent when looking at debt, because the expectation from a debt fund of an investor is different. You are looking at you are not you expecting extraordinary return. You are looking at modest return, maybe just tax efficiency, liquidity, and the comfort that you will not lose money here. And so we are far more stringent about all the things that the fund has done in the past and in many years. And if it crosses a basic threshold of something which can hit the fund. So once again, fixed income funds are also evaluated very intensely on the discipline. Once again, here, particularly in the liquid fund and the ultra short-term bond fund category, because our rating fails reasonably, primarily because the risk-adjusted return takes into account the volatility. Volatility is the yardstick of measuring risk. And the range of performance, the variance in performance of these funds is so narrow that it does not, it gives a noise rather than a real signal. So there is a lot of qualitative evaluation that goes into our fixed income thing. For investors, things are, for individual investors, investing few lakh and even up to a crore or crore and a half, they can look at it differently. For some of our, large corporate investors, we look at it a little, some added dimensions are added, that some investors should not be a significant part of the fund itself. So a lot of options get eliminated, but that is not a problem for individual investors. And so look at them for the quality, look at them for the discipline of following what they have set out to do. And what SEBI has done with their, debt style, risk matrix, I think, these debt funds will become even more disciplined. They will have greater predictability. And I think this itself will become a very significant thing, that how often the fund's, matrix position changes for a variety of reasons, whether it be, by the fund manager's choice or he has been forced to do it. But, investors will have to face the brunt. So expecting discipline of the fixed income fund is the primary driver. And that definitely translates into more predictable return, more predictable behavior. And sometimes it moderates the return. The return could be a little lower. In fact, when it comes, as I was saying, that people should not generally chase past performance in equity funds. In fact, people should, actively avoid recent past performance in fixed income fund, because fixed income fund superior performance definitely, is driven by assuming some risk which has not surfaced, and that can come and hit you anytime. And things change very rapidly in fixed income arena. So one has to be extra cautious with that. And little bit of extra return may not be worth it, because, for most investors, investment in fixed income is to, get a predictable return in optimizing your return. And it is not worthwhile to, lose your sleep on your fixed income funds.
Thank you, Dhiren. I mean, the message is a little louder in the sense, don't only just chase the past returns where you are selecting for the, your current.
Yeah, and more importantly, in fixed income, don't get attracted to slightly more return and assume great risk. It's not worthwhile.
Absolutely. But when it comes to the other way around, as a customer, as an investor, how my time horizon of investing and my risk profile and also my goals, will that play a role in selecting a fund?
Well, that is the first step. In fact, and that is something where no fund manager will be able to help you. In fact, you have to see that you have to seek an advisor, you have to you have to learn yourself. You have to clearly define your bucket, that whether your money is for few days, your money is for couple of months, or maybe for variable for for a predictable time frame within 3 years, and whether the time whether that you are unlikely to need that money for 5 years and more. That I think is a clear demarcation that 5 years and more can well be in equity. Anytime up to 2-3 years, we have known phase of the market. A lot of people think that that the definition of long term changes for different investors. For a day trader, hold taking delivery could be long term, but that's not the point. The point is that common people, common investors, who earn, save, and they have to deploy their savings to optimize return or sometimes maximize return. They have to really think that. And if you go wrong with this, if you choose the finest of fund, also get lucky with that fund. But if it is the inappropriate fund, you will be faced with a nasty surprise, and that will be very disappointing. That will be disappointing from 2 points, if on 2 fronts. One is that mostly you do those mistakes in the early phase of your investing career, or when you start investing. The one thing is that you will be disappointed by the performance itself. You expected it to do very well. You expected it to generate a 40% return every year, and it suddenly translates into 40% decline in the principal value. That is one. The other is that it will actually translate into a long-term deprivation. Most such investors, they invest and they are driven out of the market at they buy high, they get attracted to the market, they sell, and never to come back, or for not to come back for many years. And so that deprives them of the great opportunity which mutual funds actually enables them to participate in.
Thank you, Dhiren. I mean, it's I look at most of the investors when they are selecting the funds. As you rightly put it, first I need to know where I want to go, why I'm investing. My why is the most important. Why this is the long term, this is the short term, and where I want. This is my financial goal. It's fine. It's but investors simply pick up sometimes if it is something is a long term, maybe 5 years and above. They choose equity, and lesser than that, it could be a debt. It is less than 1 year. It could be a liquid funds or money market funds. Will that criteria is sufficient, or do you feel anything further to simplify the complex maths?
Oh, there is much more to it, and I think somebody needs to do the real hand-holding, or somebody has to learn it himself. Otherwise, you'll be in for a disappointment, because equity, this all said and done, it is far easier said that you should have the risk tolerance. Can you withstand, even if you ask a person that can you withstand a decline in value by 40%, and when the market is going up by 10% a month, people will be very brave. They will say yes, by all means, I can take all the risk. But the moment it's down 30%, they will change their mind. The thinking is malleable. The loss of capital has a very different impact on your mind as compared to loss of your gains. For example, if your 10 rupee becomes 15 rupee, up to 5 rupees loss, it doesn't matter. But the moment your 10 rupee investment becomes 950, you start to panic. And so these are behavioral quirks. You have lost the 5 rupee even there. And it is very difficult. It's very difficult to drive the message that timing the market is impossible. Not only difficult, it is impossible. So people think that they can do it, and they go wrong. And once you go wrong, or you do it, for example, last 1.5 year has been a phase where I have come across many people in my surrounding and people writing me mails that they pulled their money out in March and they never got an opportunity to get in. They pulled their money out 6 months ago and they didn't get an opportunity. Even now, people are asking me this question: that is it time to run? Should they should they take their money out so that they can get in again, because they are very confident that they will get an opportunity to get in again at lower levels. The point is that you can't do it, and you will miss out on some of the big opportunity. yes, one should do it in a certain way. Okay, let me first get to the first part of your question, that what are the other factors besides the time frame that you have? The other factor is, investors' experience is very crucial. If you have never experienced a market linked investment, if you have not experienced the behavior of equity investments, you have to start in a with a steadier allocation, and then get into all equity avenues. So howsoever risk assuming you may be, you have to think in terms of starting with a aggressive hybrid fund, then moving to an all equity fund, being with an equity fund for a while, and then getting into exotic categories, because most investors will buy into some story. And I think this is where they have to really resist the temptation of chasing the top performing category. For example, right now a lot of people are asking that should they be investing in FMCG or technology. And by the very nature of these funds, the narrow funds, is that they will either be at the top or the bottom of the league tables. So yeah, it will be tempting, and you have to resist that. So my sense is that investing is all about not doing a lot of things and keeping it simple, and developing your framework. But most people actually learn it from their mistakes, and it takes 5, 7, 8 years to go through the full cycle. It's very hard to, for somebody to learn it from other people's mistake, because these temptations are so real. And every time the market will look something which in a manner that it will become easy to make money, and you would have benefited from that. And suddenly, and all the biggest turnaround, they happen when you least expect it, whether it's coming down or it's going up. And we have seen it time and again in these 20, 30 years that I have looked at. And I'm now very confident that, one can't guess it. One can actually, one can be a little vague about it, but it's very hard to guess that. And but there will always be a salesperson. There will always be a person hawking a model that I will guess it right for you, and this is how you will benefit from it. And maybe once in a while they will also be right, but hard to guess. Uh, Make your rules, and make your rules 4, 5 rules of, and more importantly, make your 5, 10, 15 rules that you will never do, and then it will become very simple.
Fantastic, Dhiren. I mean, it's a great advice. Each of them can have their own investment philosophy, why they are investing, what they are investing, and probably not to manage your emotions. Maybe sometimes the right advisor will play a vital role for them to manage their emotions more than managing their money.
Oh, advisor has a very critical role to play here, because many people think that advisors will help them just facilitate their investment. There is much more to it. And in fact, if somebody is able to persuade you to start investing, think of a situation that a person is persuaded to move, instead of doing a 15-year SIP in public provident fund, somebody does in an average or below average equity fund, and then ends up with 1.5 times more money than PPF. That is what the situation is, even with the below average performing fund, which looks extraordinary. And that could be a very meaningful money, because that is one of the biggest thing going on in India. India is a fixed income country. Everybody has been doing 15-year 1.5 lakh rupees SIP in a fixed income instrument guaranteed by the government. There are merits of it, but simply for anybody who can do that 15-year accumulation, one will be much better off, and that hand holding could be very rewarding.
Thank you, Dhiren, for this. It's simply, I can say, power of compounding is always there, but power of advice can make you a little more extra of the power of compounding. Dhiren, coming back on the, when I go to VR Value Research website, and when I read Value Research Insights, and it's always ratings. Last pages of Value Research, at least 7, 8 pages. I have so many things on the ratings assigned to the various mutual fund schemes, and while selecting the funds, how much weightage I should give for these ratings for selecting the fund?
As I said initially, that it should be an elimination criteria. Also, I would like to tell you investors that don't take it to your heart. Many a times, we get frantic calls and plenty of mails. If there's a popular fund, if there's a big fund and it slipped from 5-star to 4-star, a lot of people complain that, I started investing and then I have lowered the rating. First and foremost, rating is a quantitative measure of risk adjusted return. That is it. And it gets revised every month. And more importantly, it is a relative rating. So the top 12.5% on a risk adjusted scale, they become 5-star. The next 22.5% become 4-star. The middle 32.5% on a bell curve, they become 3-star. So up to 3-star, I don't worry. And when a fund becomes 2-star, I worry. I take note of. There will be a significant relative underperformance over a prolonged period of time, which drags the fund to 2-star and below, and it slips from 3-star. And that definitely is the bottom 1/3, or a little higher than the bottom quartile. And that too, I would not worry in for a brief period of time. Yes, it stays there for a while, because one important thing is that you need to really make a choice for the long term, and there are tax implication of your decision. So you have to look at any decision holistically. That will there be an exit load applicable? Will there be a tax, tax applicable? Because the moment you have some gain, every time you move that money around, you lose 10% of your gains if you have held it for 1 year and more, and 15% if it is less than 1 year holding. So you have to see that nowadays it was different story when you were when equity was completely tax free. You can freely move your money around if it has been held for 1 year and more. Today your capital comes down, and depending, and the component of appreciation in your investment will vary depending on the age of your investment. You invested 1 lakh of rupees and you might be sitting on 4 lakh rupees gain. And if it is an old investment, and it might be a small gain today if it was a 1-year-old investment, but it would have still doubled if you just picked it at the bottom of last year. There are a number of funds with 100% gain or 80% gain or 50% gain. So you have to you have to keep that into mind. But I think I will worry when a fund slips from 3-star, and above that I will only look at it as a flag to take stock of the fund, nothing more. Than I would not be prompted to act.
Thank you, Dhiren. I mean, now, you publish once a year the best mutual funds magazine. It's a compiling. It's a fantastic thing to look at. And there are multiple articles which will talk about the best, how to pick up a best mutual fund schemes. And the immediate subject will go to the quality of the portfolio and holdings of the mutual funds. And we as a fund house, for example, at Aditya Birla, we have a fact sheet called Empire. People can get to know what are the holdings where they are investing. For a lay investor, it is sometimes looks very complicated. Is anything you would like to advise to simplify looking at holdings, or how much that is important?
Best fund is actually meant for anybody who is a mutual fund geek. There are a lot of people who are interested in learning about things rather than necessarily, they are not necessarily going to invest in 30, 35, 40 funds that we are, is part of the best fund. But they are generally curious about knowing it in greater detail. It is a handy referencer. More importantly, if you look at the best fund, the way it is, we have been, I think it was this year, it was 9th or 10th edition of that. There is a second part of best fund, which is a series, a double spread. It's a big size, it's more than an A4 size page, size book, and it's a double spread on each fund. So it is actually a information compendium of long-term performance, the portfolio characters, and everything on every fund in the country. So a lot of intermediaries actually buy it so that it is a handy reference. If anybody is asking about any fund, they will have an answer then and there. There is an alphabetical index at the end of it. The selection of 30-35 funds, which I think is not long enough, because you can choose any of those. When we are recommending about 25-30 funds in the equity category, you can do with just picking 2 multi-cap fund and one value fund that will make it a complete portfolio. You know, for different people, different number of funds can fulfill their need. My sense is that, you know, as things get get larger, people tend to, you know, when you have limited amount of money getting invested, you don't need to really work about the downside. You are still building up. Once you have accumulated some meaningful sum, then you start worrying about the downside, and then you try and spread your risk. And that is when you need to have 4 funds maybe. And I think, you know, 4 or 5 funds get you adequate diversification, and that is what that book is all about. And today, you know, I would like to reduce it to, you know, just 10 funds. But simply that, you know, there are just you know, similar funds, compelling choice, and it is very difficult for us to drop some simply because, you know, we want to have 10 of them.
Thank you, Dhiren. You know, and coming back on the next question I look at is uh, some of those mistakes or some of the beliefs people have in the mutual fund investing is when they look at NAV and investing. And there may be a fund which is 1,000 rupees NAV, then says this is a very expensive fund. And when it is, no, when we come with an NF for 10 rupees, it is the least expensive fund. How do the people get that narrative right? And you know, why they should eliminate looking at NAVs?
Yeah, you know, this is pretty straightforward, but, you know, it's that is how our life is. You know, cheap potato, or, you know, in Delhi we have, you know, some government lose elections, you know, with some you know, the change of government just because onion prices are up or low. So, you know, people relate to it in a very simplistic way. High is high, you know, expensive, and low is cheap, and that is what they actually extend to mutual fund as well. But it is not true. You can have a fund which starts from 10 rupee and it is 10-year-old, and it will have a NAV of 100 rupee, and a fund which was started 3 years ago, it can have 20 rupee. Or you can have a fund which has a face value of 1,000 rupee. That doesn't mean, you know, one has to really see that. And this is a problem we have seen even with stocks. We have seen it even with, you know, we are seeing it in mutual fund. And this is the investor, you know, this is the basic challenge of investor education, telling people that, you know, your 10 rupee will become 20 rupee exactly in the same fashion when you are buying something worth 1,000 rupee, or when the NAV is 1,000 rupee or NAV is at 10 rupee.
Fantastic, Dhiren. You know, in fact, I keep telling in the meetings where I used to go on ground. I mean, you know, when you are looking at NAV should not be a criteria to select the fund.
Yeah, NAV is not a criteria at all.
Criteria to select the fund. And, you know, I used to give a different definition to that. When I am entering into the fund, there is a NAV that is called net asset value. And if I have invested this for my 10 years SIP, it could be my retirement fund. And from now to next 10 years, that NAV for me is never available value. I don't even look at what is that. And when at the 10th year, when I want to redeem, that is now available value to me. And in between, I choose NAV to run my, to have stay patience. Coming back on the, since we spoke about expenses earlier when you are mentioning, and how good this expense ratio to be chosen, expense ratio we need to follow for selecting the fund, and what are the primary concern investors should have when it comes to the expenses?
No, one is that, you know, one has to look at expenses seriously. Everything else in being equal, expense is the only differentiator. You know, if you have two funds managed by equally competent people, and they are able to deliver exactly similar return, the one with the lower expense will actually deliver you superior returns. So everything else being equal, lower expense matter. Also, you know, it is very difficult to, you know, because it's a formula driven thing. We know that the expense ratio is a function of variety of things that goes into it. And Indian situation is very unique, you know, B50, B30 incentive, and, you know, the exit load, entry load charges, or, you know, the benefits getting there. So the expense ratio, what we actually see may not be as clear. So I would say that expense ratio matters. In fixed income, it is material. It is very important. In equity, you have to look at an expense ratio beyond which you will actually say that this is expensive. Otherwise, and that is how we look at value research. In equity funds, we say that, okay, 1.25% to more than 1.25% of an actively managed fund, however brilliant it be, in the direct plan is beyond that is expensive. In case of fixed income, that sometimes expense itself is the performance driver. In case of liquid fund, in case of ultra short-term bond fund, and in other fixed income categories too, because all these expenses, you have one should look at it very realistically. When when the interest rates were 10% and expense ratio was 1%, that was fine. It was still one way to look at it is what percentage of the gain of the asset, because expense is always in terms of percentage of assets. But one has to see that if a fund was generating 10% and 1% expense ratio means 1/10 of the gain is gone on account of expense. And so you have to see that today, if liquid funds are generating 3.5% or 4%, then what kind of expense is actually a drag on the fund performance, or lower expense or higher expense? And today, so much so that today it is going to be a big question that should individual investor, is there a case for the liquid fund for an individual investor? Many a times it crosses my mind that why one should. Expense matters. In case of fixed income fund, they're very important. In case of equity, you have to see, because this is a long-term cost, you have to see that it is not crossing a threshold on a relative basis.
Thank you, Dhiren. I mean, the next question I look at is people having invested. Most of the times they look at their performance month on month. And there is a comparison with the benchmark, there is a comparison with a peer, there is a comparison, आपके fund, it is not performing, that's a statement comes. In such case, how often people need to review, and if there is a performance, there is a slowdown in performance, when they can take a decision, either to not to stay with that fund or switch to the other fund.
For this question also, I'll have two kind of answers. One is that for a new investor getting started, for 3 years, don't even evaluate don't look at the performance. Be very careful, thoughtful about your actions. Look at the equity fund, look at the tax saving fund, look at the aggressive hybrid fund which you have chosen, and don't do anything about it for first 3 years. Be very extra cautious, careful, put all your effort, and don't look at that, because that is when the magic happens. You will be, worrying too much about it, wanting to take some action, and the accumulation itself isn't meaningful enough for you to benefit from it. And I think in normal course, it will be reasonable for most common investors to be doing an annual review. And only when you have sizable money and you are generally very anxious to do it, there could be a situation that once you have sizable accumulation, and that too for your for an important goal, or just for that is your financial worth, that is the time when you should actually set your asset allocation, and you should be looking at it to rebalance it. And that is if your asset allocation goes completely out of whack, which means something dramatic has happened. And it is always, it will always hurt if you take a reckless decision of, moving out of equity or getting into it. And it is very, as I said earlier, as I discussed in great length, that it's difficult to do it right. So change your allocation a little bit. Sell some equity if it has gone up. Reset your allocation. And this is a minor shift. This will never be a dramatic shift. And that is how you will be able to benefit from the madness of the market. That is how you will be able to, buy low and sell high. Otherwise, most of the time, investors end up doing it. But do it after you have your accumulation is something meaningful. If you are trying to do all this activity when you have, we don't have a reasonable allocation, a reasonable accumulation, this exercise may not have it may not be rewarding enough.
Thank you, Dhiren. I think I'll go to the audience questions. Before that, I'll have one question with you. Sure. Is earlier we all used to get that active funds, actively managed funds. Now we spoke even passively managed funds. The contribution to the industry itself is going up. It's over a period of time now. And what is your suggestion for selecting the schemes or investing passive versus active? Is it the combination of both, or how you need to choose that?
I normally don't buy into the fads. And I think, this talk about the active versus passive is entirely guided by the fact that, one of the index fund has become India's largest equity fund. The SBI index fund has become the largest. That doesn't mean that every Indian has, uh, got into investing in index fund. The fact is that, it is the employee provident fund money which is getting channelized into that. And they are doing it simply for sake of convenience, for ability to do it with simplicity. And otherwise, it will be very complex for a government run setup to make choice of an active managed fund and be neutral about it. So index fund is great for that. And then at a certain level, the self-fulfilling, cycle has triggered that, there is a certain amount of money that flows into index stocks through this index fund. And that is why the index funds, index stocks just refuse to go down. It has never happened in the past. We will always have something which is playing catch up with that. Uh, so I would say that this is they have not gained popularity. Indian investors still have, and the jury is still out. Maybe the large cap funds will have a great difficulty in beating the benchmark simply because they have a distinct disadvantage. They have an expense ratio of 1% or 1.25%, and the index fund has a 10 basis point expense. So if the fund is able to beat the index by 1%, it will barely match the index. And for an investor, it is a simple choice that at least you are guaranteed to get as much as index. There, sometimes you will get more, sometimes you will get less, and maybe hopefully in a long period of time you will get little more than the index. And one doesn't know. So maybe a passive, but my sense is that a emerging, evolving market like India, we still have great companies coming from the non-index, beyond the top 50, top 30 companies, which are part of the Nifty and Sensex. We still have great performers there, and lot of things needs to be unlocked even now. We still have great things. If we have this whole turning point, what has happened in the economy in the last 2, 3, 4, 5 years, we will have a different set of companies which will come on the forefront. And I think our index was also not created. Initially, the index was not crafted to be an investment vehicle. It was crafted as a barometer of the index, of the market in general. And a barometer of the market in general, it is a very narrow barometer. It is a very skewed barometer because index tends to have representation of all the sectors. And all the sectors in India, they are not as globally competitive businesses. We have a lot of businesses which are globally competitive. We have a lot of businesses which are not. And they are incompetitive by a wide, below the threshold, hygiene of being an efficient business. And that is why we see that many of those businesses are struggling, but they will necessarily be part of the index. I have never seen the kind of mortality or phase out from the index as we have seen it in India. Recent mortality or phase out from the index, if I look at it, the Suzlon and the Arcoms, the fund has to, people may not decode it, but an index fund has to necessarily hold those stocks till it is phased out of the index. So you are holding a dead horse simply because it's part of the index. And that is actually the unfortunate part. If indexes have become a major vehicle, then I think those hygiene factors of companies getting into the index and companies getting weeded out of the index should be far more stringent, which it is not today, which to be of great disadvantage to the investor. So that is my, but it is not a bad idea to be investing in index because you have multiple ways of investing in market. As I was saying that, most people will earn little less return in an aggressive hybrid fund, but it is a good way to start. Likewise, index fund will be another way to start because you are at least investing in equity. Then comes an actively managed fund if you can. Then maybe an aggressive fund, if you are able to have a multi-cap fund which is supplemented by one or two carefully chosen mid-cap and small-cap fund, nothing like it. And then there will be some investors who have the time, inclination, as well as the temperament, who will build their own diversified equity portfolio. These are different ways of achieving the same goal. Be an equity owner through different vehicles. That is one more vehicle. And I'm not against that. I just think that, the jury is still out on the active versus passive.
Thank you so much, Dhiren. Now I'll go back to the investors' questions. There are a lot many questions. Probably we will have a little rapid fire. And this question coming from Chitur Ramana. Can we select any scheme based on the CAGR return for a period of 5 to 10 years? This may be considered is reasonable or not. Can you please clarify?
Yes, it could. If you are looking at a longer time frame, those numbers are more credible. They are unlikely to be, a freak performance, because 3 months, 1 year returns could be quite misleading. If somebody is looking at 1 year return today, might get quite misled into the expectation which will never be met. So that's one. But if you go to value research online, you get a very interesting piece of information, and it will give you a deep insight into we calculate in the life of a fund, depending on its age, we look at the best and the worst period, best and worst week, best and worst month, and best and worst year in the life of the fund. And that is something which will give you an understanding of what to expect. What are the best case and worst case scenario? You will come across the finest of fund. When it comes to mutual fund, look at the worst case scenario and see that, will you be able to reconcile with it in the worst of times? Because that is something which you will be faced with. That is the time when you have to make a tough call. When the market is doing well, I don't think you have to make a decision. You will just feel happy, look at the numbers, feel happy, celebrate, maybe take some money out, have fun. But that's not the way to look at it. The way to look at it is, can you withstand that kind of pressure of decline? And that is a very important performance measure which I look at. And worst of times are the times, you will come across a multi-cap fund, something which went down by 70% and something which went down by 35%. And that is quite a difference. Likewise, you will come across small caps which went down by 85% and ones which did not go, go beyond 65%. So that is quite a difference, because one should understand that, the psychology of decline. One is that we get anchored to the highest price that we have seen in the life of a fund. That becomes a big barrier. We always keep waiting for that. Then comes another issue that, simply the percentage gain that you need to recover a fall. A 50% decline in a fund, it needs to gain 100% to break even. So percentages also can be misleading. You have to really understand the percentage. 35% decline, and then you understand that, okay, 50% gain, and you will be, a third decline will to be recovered, you need a 50% gain.
Thank you, Dhiren. The next question comes from Mr. Anand. There are a lot many questions. I'll run a little faster. And Anand question is, in the current scenario, debt funds are giving very low returns. And does it make a sense for an investor to shift to equity funds?
If you are a fixed income investor and you are getting low return, you should never consider, if this money is meant for, if you are likely to need this money in 2-3 years. No, never. Reconcile with a lower return. If this is a long-term money and you are into fixed income, yes, by all means. If you are a very careful investor, maybe not all the money, maybe 10%, 20%, 25%, and to reduce the risk of investing in equity and not eliminating the possibility of catching a market high, always spread your investments over time, even if you have lump sum money, because many investors invest in fixed income simply because you can invest a large amount of money without much of the risk of catching a market high, which is a big risk when investing in equity, and that to a not so experienced investor. So by all means, do that. Invest a part of it if this is your long-term money. If this is money which is needed, don't even consider that, and don't even assume risk in riskier fixed income funds, because that may not be worthwhile thing. earning
Absolutely.
0.5%, 1% more to put your capital at stake.
Absolutely, Dhiren. And Dhiren, a lot of questions are coming on offshore funds. Mr. Lognathan and many others were asking, is it the time to allocate money to the offshore funds? And it's investing in the purely foreign funds, and whether the diversification is good enough. There are few questions around that.
Yes, the reason why you invest in equity and the reason why you invest through mutual funds in equity is the reason why you should be investing in international funds. And today it has become very easy for you to be investing in funds just like we do in Indian fund. And these vehicles were not possible earlier. You have plenty to choose from, and new and new varieties are coming with. And fortunately, normally I say that don't invest in a new fund because the credential, the track record is not proven. And most of these vehicles, most of these international funds, they are vehicles with a long track record, with a long history, and they are fund of fund. You invest in your money in a fund, which in turn invests in another fund, which has a long history. So, and when you are looking at the offer document, you can see the rupee denominated. Investors may not have invested here. It may be a new fund for Indian investors, but the rupee denominated performance numbers will actually give you a sense of what it is. Many of these things are quite. I particularly like the international flavors as a supplementary part to any portfolio, simply because many of these businesses we don't have such investment vehicles available in India. If you are investing in a Nasdaq 100 fund, it's getting exposure to a segment of the market which we don't have access to. If you are looking at another international fund, actively managed US opportunity fund and vehicles like that, you have I would say that even there you should follow the same principles that we apply in investing in a diversified Indian fund, which is choose a diversified vehicle, because there also you will have a situation that a narrow vehicle will turn out to be giving you extraordinary return and proving to be extremely disappointing on occasion. So then you have another advantage that because interest rate differential continues in in India, so we will always, over a longer period of time, we will always see a rupee depreciation. In the short run, it could be anything, but in the long run, there will always be a rupee depreciation, which will translate into a couple of percentage return on an annual basis, and it will happen in a time frame of 4 or 5 years. It doesn't really show up on a day-to-day basis. So these two factors are good enough for you. Diversification, getting a segment, getting an exposure which is otherwise, and they are very unusual kind of hugely rewarding businesses, hugely dominating businesses, and the rupee depreciation. These three, and the convenience that has come for you to invest through the most Indian funds now offer one or two ways such vehicles. So choose it carefully, apply the same principle, and by all means invest.
Thank you, Dhiren. I mean, this is a question coming. There are two questions I clubbed together from Nilesh, whether value research is making a comparative study of expense ratios and whether it is publishing. And if the fund is performing below the benchmark, whether mutual funds are allowed to charge these expense ratios to the fund.
Oh, the expense ratios are independent of the performance, because in case of open-end fund, in fact, I am also part of a SEBI committee, mutual fund advisory committee, and it is often being discussed at least once a year. It is being discussed that is there a mechanism of linking expense to the performance, and in a certain way, even now it is linked, but not in a manner that it is zero or whatever expense. I'll tell you why. Open-end fund you can redeem or you can invest anytime, and that is why the NAV is calculated every day, and the expense has to be charged every day. So if it has to depend on, and I have come across many fund managers who like the idea that they would like to be paid only if they do well, and if they are unable to if they are unable to beat it, or they are unable to match the benchmark, they would not like to. But there isn't a way of doing it objectively. But in a certain way, it happens even now, which is The formula or the idea that you are suggesting is very much possible in case of closed-end funds, where you invest and you invest and hold your money for a longer period of time. In a certain way, as I was saying, that in a certain way it happens with open-end funds, because fund managers make more money when asset value goes up. And if the best performing fund is charging 1%, it is actually able to charge on the growing value of the money, as compared to a fund which has been a laggard, which has not been able to grow the money as fast. So say there are two funds with 100 crore asset base, and one fund becomes 200 crore, and the other fund becomes 150 crore. So the fund which has been able to grow it to 200 crore on account of appreciation will be able to make more money.
Thank you, Dhiren. Dhiren, next question comes from Arvind Moturi. I'll take a couple of questions. Hope you have time. We are already exceeded. This could be the last but one question. Arvind Moturi says, what should be the priority while searching for the good mutual fund? Is it the sector or previous performance or the fund manager's performance? Could you please advise, and is there a sequence to be followed?
Yes, there is sequence to be followed. One is that look at the performance over a longer period of time and look at it holistically. Don't get attracted only to the performance. Normally, when I'm looking at the past performance, I'm looking at, as I was saying, that the best and worst performance during the period. So that is a very crucial part of my evaluation, how bad it can get. Because good, we don't know, but bad, if it is demonstrated, you have to see that is it acceptable. So that is the starting point. Even a rating, which I was saying that 1 and 2 star funds are avoidable funds, they are at the end of the day dependent on the performance and the volatility. So if you are taking into account the long-term performance and the rating, you are taking into account the performance. Then comes portfolio. Portfolio, I would not like you to look at portfolio in a micro way. I come across many investors who try to overanalyze the portfolio, that why this fund manager has bought this, why he has not that. We don't know why he has bought this and that, and with what time frame in mind, with what thought in his mind, that how it be complementing his portfolio in general. If a fund manager has 20 stocks, of which he thinks that he will be holding these 10 stocks for 5 years and more, and then these are 5 stocks which he'll be holding for maybe next 1 year, is the opportunistic bet for him. Now, we are not reading his mind. We don't know, and you will be building your biases. You have to really see that and all those judgment of the fund manager, and we are paying him money for taking all those decisions. We are paying the fee of an active fund management exactly to take those decisions. So I would say that I would try to look at third thing which I would like to look at is the continuity of fund manager, and I would look at portfolio for its discipline. If the fund manager follows some kind of measurement, some kind of rule, that it will not let any position go beyond 8%. It will not it will not build a long tail in the portfolio. I have come across funds which becomes very really unmanageable, or I really wonder that how those fund managers actually manage it if they have 120 positions in their portfolio. Is it meaningful enough? Similarly, and it can vary depending on the kind of fund. In case of a small cap fund, I will be very I'll be very scared of any fund which has built 5 positions of 8%, because the likelihood of the fund getting stuck in some high degree of illiquidity is very high. Likewise, in case, so depends. I will be looking at these issues while evaluating the portfolio, not in terms of looking at a position of a fund manager and forming my opinion that okay, he's not doing a smart thing, or he's a brilliant guy because he has bought something which I like. Those are unnecessary biases which we can build about a fund based and that could be quite baseless.
Dhiren, this is the last question I will be taking. Rest we will answer later. And this is a question coming from Mr. Manmeet. If one has 20 lakh lump sum and who got the ability to take risk, how that person should allocate the money into the mutual funds? Is it the lump sum investment? Is it the STP or one-time investment? And
If somebody is willing to take risk and has 20 lakh rupees, I would say that, you know, by willing to take risk, you don't have to necessarily, take risk to be hit by that. Still, I would warrant you. I would say that if this 20 lakh rupees is a very important money, if this is money is of a person who has got this money on account of his retirement, then I would ask him to spread it over the next 3 years. Divide this money by 36 and invest every month in a diversified fund on the assumption that you are unlikely to need income from this money. If you are willing to take risk, and if a part of it goes down in value, I would still urge you to spread this money over 6 to 12 months, because the disappointment of catching a market high, yes, if it was a situation like last March, I would have been tempted a little bit. But even then, because we did not know, I would have wanted you to invest and spread your investment over the next 2-3 months, because when it starts crumbling, we don't know how low it can get. So I think uh, forming a prudent approach to investment is crucial, and that is why if you miss on some opportunity, but you end up being prudent about your money decisions, I think it will have a long-term payoff, is my belief.
Thank you, Dhiren. Indeed, it's very engaging. You always comes with a wisdom and there's a practical orientation. Thank you, audience, for being here for this evening.
Thank you,
And
Mr. Rao, for enabling this, and thank you, Prem, for having me here.
yeah, thank you. And
Great.
Prem will be joining us now. And I think I'm very thankful to the audience. And it is a series which we have started as a smart investing. Smart investing is always, we can think of smart goals. Probably Dhirendra has defined smart today a little differently. If you want to be smart, first is S can stand. You can simplify yourself on your goals and your investments. And M is you are matching your goals with the investment objectives, scheme objectives while choosing the fund. I mean, a could be have an advisor that can make a lot of difference to become smart, and or is check your own risk profile. T is the time horizon you are looking for it, and the takeaways I look at from your session for long is before investing any fund, you must first identify your goals and choose your investment and the right objective of the fund, and you can match that. And prospective mutual fund investor should look at his or her risk tolerance. And choosing the mutual funds, probably rating can be a criteria, but that can be an elimination criteria. It is a very interesting. I invite Prem for this. Thanks a lot, Dhiren. I always enjoy and it's a lot of learnings. Uh, Prem, over to you to the session.
Yeah. Thank you. Thank you. That was a wonderful session, Dhirendra. Wonderful session, Mr. Rao. Thanks
Thank
for
you.
getting
Thank
all
you,
the
Prem.
wisdom out of Dhirendra. So and I'd like to thank all of the people who've been a part of this wonderful evening. And I hope you've taken a lot of wonderful insights from this. So with that, I bid you good
Thank
night.
you so much.
Okay.
And stay healthy and stay wealthy. Thank you so much to all. Thanks to Prem at Cafemutual. Thanks, Dhiren. And once.
Thank you, Prem and Mr. Rao,
Thank you.
for
Bye.
this
Bye.
opportunity. Thank you.
Bye-bye.
Bye, everyone.